There is one very common problem that hurts many traders, even those who have a good strategy. The problem is that there's a hidden risk caused by correlated trades. You may think that you are taking several different trades, but in reality, you may be making the same bet several times. And then, if the market moves against you, all those trades can lose together and damage your equity very quickly. And the worst part is that many traders do not even realize that this is happening. So in this video, I'll show you how correlation works, how to spot it, and how to reduce your risk when several correlated trades appear at the same time. Let's get to it. So there's something which is called positive correlation, and also there's negative correlation. Let's start with the positive correlation. Positive correlation, it's not all the time, but at certain times, some markets correlate quite heavily, which means that they move the same way. If you compare those two charts, which are Australian dollar US dollar and New Zealand dollar US dollar, at some areas in the chart, they correlate quite heavily. So let me mark those. At first sight, it is this zone and this zone, right? The sell-off on both instruments. Heavy correlation was also in here where there was a rotation before at that sell-off. Before that, there was this selling activity and this selling activity. It was bigger on the New Zealand dollar US dollar, but still those two pairs were correlating there. Then there was this zone, also visible on both pairs. Then this rotation, which you can see in here, this uptrend, which you can see in here, and so on. Alright, so this is positive correlation. It doesn't happen all the time. As you can see, for example, in here, the markets didn't really correlate too much, but still there are signs of positive correlation. Now, why I'm talking about this is, imagine you are in a trade. Imagine you are in a long trade. Imagine there's some support on the Australian dollar US dollar in here. And imagine you also have a support on the New Zealand dollar US dollar in here. So imagine you enter a long from here and also at the same time a long from here. You are in two trades that are correlating heavily. So in both those trades, you take a stop loss because the price just shoots past that long. And you are taking double damage. And those trades are more or less identical. And if you are taking trades like this, it could be cause of a stronger drawdown. Now let me show you what negative correlation is. It is basically the same as positive correlation, only it is reversed. There are certain instruments which correlate negatively. Very often it's the euro dollar and US dollar Swiss franc. So they very often move the opposite way. For example, this zone and this zone. Right? Euro dollar was going downwards. US dollar Swiss franc was going upwards. This is negative correlation. So when the markets correlate like this, and if you happen to be in a long trade in the euro and at the same time short trade on the US dollar Swiss franc, then again the market's going against you in both cases and you are taking double damage. Do you see how risky this is? Now, what about triple damage? This is where it gets really serious and really dangerous. So here we have three markets. Imagine a trade where you are long at the British pound US dollar, long at Australian dollar US dollar, and short on US dollar Canadian dollar. By the time this selling and this buying activity are taking place at the same time. So if you take these three trades, you are taking triple damage. And with trades like these, a drawdown can happen very quickly. So that's why you need to reduce the damage. In other words, reduce your exposure to risk. So what you do when you see something like this happening is you lower your trading volume, and I do it to 50%. So if 3 trades are likely to get triggered at the same time, and clearly the markets are correlating, then it's only 50% positions. So if I normally risk 2% per trade, then now I'll only risk 1% of my equity per trade. Now keep in mind that this needs quick thinking, and you need to detect that there is that correlated movement, very often driven by one currency. In this case, the move is clearly driven by strengthening US dollar. In here, US dollar was strengthening, in here as well, and in here it was also strengthening. So if you are trading like this, and if you see one currency strengthening or weakening all across the board, and you have some trading levels which you would like to trade there, then what you should do is reduce your risk, because it's very likely that all those trades, in this example, all those 3 trades will have the same result. All of them are likely to be winners, or all of them could be losers. So this is the way how you can prevent drawdowns and reduce risk. Now I'll give you a little bit more info about correlation, so you know what to look for in your trading. Correlation is changing over time and is different on different time frames. And strong correlation very often occurs during macro news and during important events which are affecting one currency. All right, because for example, during macro news, what usually happens is one currency is strengthening or weakening, and that causes all the pairs where the currency is present to either go up or go down, and everything is driven by just that one currency where that macro news was. So this is where strong correlation occurs very often. Now there are also some trading instruments and some forex pairs that typically correlate heavily, even if there's no macro news. And in the picture below, I picked some of the most traded instruments, and the table shows the correlation between those. Now let me show you the most important ones, the instruments which have the strongest either negative or positive correlations. It is the euro dollar with US dollar Swiss franc. You read it like this, okay? This field shows the correlation between euro dollar and US dollar Swiss franc. This is correlation on the daily chart, by the way. And it says -94, which means that at this time, those two have a very strong negative correlation. By the way, correlation goes from -100 to +100. So -94, that's almost -100, that's very close to it, which means that the correlation is very heavy. Now, what also correlates pretty heavily, and not just during macro news, is gold and US dollar Japanese yen. So here is gold, here is US dollar Japanese yen, and this is very strong negative correlation. So imagine a scenario where you are trading long on the gold and short on US dollar Japanese yen, then most likely those trades are going to correlate, and most likely both trades are going to be winners or losers. So this is big risk exposure. Now let me give you one more. It is Australian dollar, US dollar, and US dollar, Canadian dollar. Those two also correlate heavily, -76%. At this time, when I was taking that screenshot, as I was saying, the correlation changes over time, but at this time, it was like this. Sometimes it's even more, and it's not just during macro news, all right? So it's worth it keeping this in mind when you are trading those instruments. And if you want to check this table and some more tools, then go to this page. I will leave a link below this video, so you can just click it and go to that page. It looks like this. In here it says if correlation is high, above 80%, then it's positive, and currencies move in the same way. If it's below 60, the currencies don't move in the same way. Here is the table. You can adjust it in here, and in here, you can find the instruments you are interested in. This is where you can change the time frame, because as I was saying, correlation changes over time, but it doesn't change too much, especially if you are using higher time frames like the daily time frame. Alright, so that's about the correlation and about the risks that the correlating trades bring.